age by working with them to incorporate some of the variables that we have figured out how to use for better underwriting. So I don't think they're going anywhere. I think they're going to continue to be the dominant name in underwriting.
When you're taking credit decisions into account, what type of data are you collecting about consumers that are maybe broader than a traditional credit card company or bank?
The FICO score speaks to just the person and their overall financial health and their past ability and willingness to repay their bills. It's very broad and kind of a good foundation, but to approve or decline someone to a specific purchase means you kind of have to understand what the purchase is, and we do that. And I think that's ultimately the future of underwriting.
You mentioned the fact that you were an immigrant and couldn't get a card when you came here because of that, and the credit history that you did or didn't have. So are there things about the person themselves, the borrower, that you have to take into account?
Yes, although that's a significantly harder thing. First of all, there's a tremendous amount of privacy concerns that you want to be on the right side of. The one thing that you can, and we do sometimes get access to, and it's profoundly, could be a life-changing access to credit moment for some folks, it's personal financial state as seen through the lens of their bank account. If I understand your personal cash flow, it doesn't really matter what the credit history says. That's a financial picture that is very, very difficult to capture in your credit bureau profile, and that's primarily what the FICO score is built off. And so there are hidden facets of consumers that we know how to look at, and many traditional scores do not.
There are a lot of buy now, pay later companies. When you are buying now, paying later, sometimes you can pay or buy now, pay later with your credit card. That means that you are borrowing money and then you're borrowing again on a credit card. Does the model itself create new risks? That seems like leverage on top of leverage, Max.
Affirm is not an add-on to your credit card, it's a replacement. That's the idea. So what you're describing is a behavior that we do not encourage, and in fact, very actively try to prevent consumers from doing. We launched our Affirm card with a very clear view that, hey, you can put that credit card back into a drawer and never take it out. The Affirm card is both debit and the borrowing capacity in a single product, but both are safe. They're both Affirm-powered pay later features where you will either settle your bill quickly or you'll pay over time, but there are no late fees, there's no revolving, there's no leverage on leverage.
Something I wonder about the credit product is this kind of showing you that the buy now, pay later model is not the end all be all, that in some ways, the credit model works even better.
The Affirm card is not a credit card. It is a debit card, first and foremost. When you swipe it and move on, it will take money out of your checking account, your existing checking account. The end. That takes 2 to 3 days to settle, but that is not a credit transaction. It is a payment. You can say, hey, that thing I'm going to buy, I am going to borrow for this because it's more than I have in my checking account. The card says, oh, great, I know what to do next. So when you swipe it, the next transaction sort of automatically becomes a loan. Those two modalities, it's unique. No one's ever done this before. It's a very, very different product. It's taken us a little bit of time to figure out how to educate the consumer about it, how to make it all work from compliance and risk and underwriting and cost perspective. But it is not a credit card. It is an anti-credit card, in fact.
So what is the purpose of the credit card for you?
Credit cards are kind of a coal-burning plant of the payment industry. I think it's time to abandon them in favor of cleaner energy alternatives like the Affirm card.
But why is the Affirm card an answer to the credit card?
The credit card is, you swipe it, you revolve, you buy now, and you pay for indeterminate amount of time, possibly forever. Affirm card is a fixed term loan for every transaction. There is no revolving. There is no bucket of debt to fill up and then figure out later. It's a much simpler, higher control product.
Coming up, the future of buy now, pay later. This is Bloomberg.
There's all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Welcome back to the Bloomberg Markets Magazine interview. I'm Shonali Basak. The future expansion of buy now, pay later appears bright, but that kind of success also comes with scrutiny from the CFPB working on regulations for the sector. I asked Max how he views potential regulation, and then also what private equity snapping up buy now, pay later loans means, and how a firm is working with the regional banks to help alleviate duration risk.
The collapse of SVB and the turmoil around regional banks showed us that duration risk is just as big of a deal as credit risk. Regional banks watch this with horror, are liquid and are really well managed in terms of credit, and there's not a long list. Affirm is one such company. And so we've seen tons of interest from regional banks, super regional banks, anyone who's got significant consumer deposits. This is a great place for them to put their money to work, and we will take good care of it in very short-term increments.
What's the difference for you between working with a bank, a regional bank, or a private credit firm, which have been increasingly more important as the banks have been shrinking?
There are also insurance companies we work with larger banks, we also securitize our loans, and with really big banks, we have multiple warehouse lines where if we feel that we want to hang on to these loans on our own balance sheet, we'll warehouse them. And so in aggregate, it adds up to a very healthy ecosystem of funding, and our cost of capital is something that we report on every quarter. Obviously, these things have some amount of lagging effect, whereas some of these deals renew, we renegotiate to reflect the recent changes in the Federal Reserve action. But ultimately, it is the plurality and the diversity of the funding ecosystem that we have created that has allowed us to maintain our margins and also deliver good yields to our partners.
You saw earlier this year, KKR, for example, agreed to buy as much as $44 billion of buy now, pay later loans from PayPal. And could you see yourself doing a deal so large?
I certainly can see us getting to that scale at some point reasonably soon. So I feel great about the precedent that's been set here. Obviously, can't comment about any deals that are not public knowledge yet, but certainly the model, that particular deal proves a model, and frankly, I think creates another sort of stamp of approval on the buy now, pay later industry.
The Consumer Financial Protection Bureau in particular has raised a lot of concerns about the buy now, pay later model. What kind of future regulation do you see, or clampdowns on the industry that could really change the way it works?
I think regulation, when done right, is a good thing. It creates equilibrium settings in the market, allows for fair competition, protects consumers. So all of that I am generally in favor of. I think buy now, pay later industry, except for Affirm, as is frequently the case, should not be unchecked in its fee schedule setting. But there's plenty of late fee harvesting, as they call it, taking place in buy now, pay later, and a little bit of a spotlight from the regulators wouldn't hurt. In places like credit reporting, you should be able to build your credit score by using buy now, pay later providers in a predictable way. And today, We report, majority of our competitors do not. I think writ large, if you are building a company that is committed to transparency, as we very much are, regulatory attention is a cost. I think we should expect more regulation, more attention. I don't think it's going to be a dramatic change, of course, for us. I kind of hope it causes some dramatic changes for some of the folks that have already figured out business models that, frankly, are not particularly pro-consumer.
That's all for this episode of the Bloomberg Markets Magazine interview. You can find more from Max at Bloomberg.com, the Bloomberg Terminal, and the latest issue of Bloomberg Markets Magazine. I'm Shonali Basak, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Hello and welcome to Bloomberg New Economy Forum, Embracing Instability. I'm Eric Schatzker. These are troubling times. After 75 years of relative stability, the Pax Americana, when the U.S. dominated the global economy, we live in an increasingly multipolar and fragile world. Multiple countries are battling for influence in trade, in technology, and for territory. Globalization is receding. Authoritarianism and imperialism are ascending. CEOs, financial titans, and heads of state are speaking out about the dangers of geopolitics. Against this backdrop, we brought 450 leaders from across the globe back to Singapore for the Bloomberg New Economy Forum. Our goal? To bridge the divide between East and West and the divide between the global North and the global South. The discussions here ranged widely, covering the testy U.S.-China relationship, the risks of widening wars in both the Middle East and Eastern Europe, and the choices and sacrifices we'll need to make to save the planet from climate change. Let's begin with a question that will determine the fate of the world, whether the U.S. and China can de-escalate. Chinese Vice President Han Zheng opened the New Economy Forum and offered his perspective on the economy, on trade, and on dialogue with the U.S.
Changes unseen in a century are unfolding at a faster pace across the world. Global economic recovery lacks momentum. Geopolitical tensions are compounded with the evolving economic landscape. Crises of food, energy, and debt are emerging. Having said that, the deepening of the new round of technological and industrial transformation has brought new opportunities for sustainable economic growth. Humankind is a community with a shared future, and a win-win cooperation is the sure way to success in doing great things that benefit all. China is ready to work with other countries to seize the development opportunities of our times, jointly address risks and challenges, and create a better future for mankind. Unilateralism and protectionism lead nowhere. The issue of security cannot be overstretched. Decoupling, severing industry and supply chains, and the so-called de-risking will all only divide the global economy into many isolated islands. We need to follow the laws of economics, support multilateralism, promote the free flow of production factors in the global market, and build industrial and supply chains that are convenient, efficient, and secure. Addressing global challenges requires cooperation and joint efforts of all countries. You all follow China-US relations closely. President Xi Jinping has stressed on many occasions that whether China and the United States can find the right way to get along bears on the future of humanity. The world is big enough for the two countries to develop themselves and prosper together.
Pragmatism is surfacing. We heard it from the Vice President today. A call for collaboration and coexistence between the world's two economic superpower and geopolitical powers as well. We in Saudi Arabia have traditionally had a very strong relationship with the U.S. going back to the creation of the third Saudi state in the 1930s, and of course that relationship has gotten from strength to strength. China is our biggest trading partner, biggest importer of Saudi exports, whether it's energy, chemicals, and other goods, and at the same time they are our biggest exporter of industrial goods, and that relationship is set to continue to strengthen. And we hope we, like Singapore, can play a role in promoting dialogue and cooperation between these two countries.
There's a lot there that we will get into, but Minister Balakrishnan, on the state of the world right now in US-China relations.
With the US and China, I differentiate between climate and weather. Right now, I think the weather is a bit sunnier. They're preparing for the APEC meeting, and we all hope the President Xi and President Biden will have a good meeting so the weather is improved. But I think the climate, the relationship between the United States and China is not in such a happy place.
The climate generally is getting worse between the US and China. Again, I think people would say it was better when you were around. Is there any sign of things getting better, or are they just going to get worse for a while and then maybe stabilize?
You know, part of the reason it was, you know, somewhat more positive when I was there, and we had a very regular set of meetings, is because Hu Jintao was a Chinese leader who decided he would not stay for life. He would fulfill his term. He would follow the guidance of the Chinese Communist Party. There would be a transition, a new group of leaders, you know, some holdovers, but, you know, other new faces would be in power. And so there could be a constant renewing of both the Chinese government and, through that, the American relationship. Once Xi Jinping decided to stay in office for life, that creates a lot of you know, challenges within their own system. And I think we're seeing some of that with the removal of top officials, some of the economic problems in the Chinese economy, but it also creates a kind of chilling effect in terms of relations. I mean, how do you deal with somebody who's not going to be held accountable? You know, I mean, their system of accountability was certainly different from ours, but it existed. And now it doesn't. And so part of what I hope will come out of this meeting is an attitude by President Xi that, you know, he wants to get back to some kind of regular order, that he sees it in China's interest to really dig in with President Biden, develop a platform for discussions, for problem solving, look for ways to cooperate on whether it's, you know, climate change or other matters that may be of mutual interest to us, really sending that signal. I think he will find a receptive partner with President Biden if that's available.
Coming up, Ken Griffin, the founder and CEO of Citadel. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Welcome back to Bloomberg New Economy Forum, Embracing Instability. I'm Eric Schatzker. On day 2 of the forum, I spoke with Citadel founder and CEO Ken Griffin. As you're about to see, Ken is full of conviction on everything from interest rates and inflation to the criminal prosecutions of former President Donald Trump.
Regretfully, the peace dividend is clearly at the end of the road. no matter what one may dream to be reality, reality is there's two wars in the world right here, right now, one of which is in Europe. So there's no doubt that the NATO countries are going to have to increase defense budgets over the years ahead. That's going to come at a point in time where governments around the world are already struggling with the sizes of their deficits. And then when it comes to globalization, I mean, we're in Singapore. We are at one of the global nexus in the world of trade, of finance. Many of us in this room have been tremendous beneficiaries of globalization, and it hasn't been great for everybody, to be clear. But for the world as a whole, it's pulled 1 billion people out of poverty. But now we're talking about deglobalization. We're talking about re-architecting supply chains. And some of this is rooted in the behavior that we saw in the pandemic. We saw countries hoarding personal safety equipment. We saw the tension around the distribution of vaccines around the world. Countries are much more sensitive to what do we want to have created domestically so that we're not reliant upon global trade. And then take that into the general geopolitical trends right here, right now. The war in the Ukraine has resulted in Europe losing access to natural gas from Russia for all intents and purposes. Europe struggling to deal with how does it maintain its economy having lost its cheap source of energy. So there's many trends at play right now that are pushing us towards deglobalization. And with that is almost certainly a trend towards higher baseline inflation.
Over what period?
It could be for decades.
And the implications of higher inflation might be obvious to some, but I think we'd all like to hear it from Ken Griffin.
Well, it depends on where this baseline effect lands. If we're looking at a 2 or 3% baseline effect, in some sense, the central bank will have a much easier job in the United States. The struggle over the last 20 years has actually been to hit a 2% target. And there's a variety of reasons that you want a low level of background inflation. It helps to lubricate the wheels of commerce. And that number the Fed has committed to as being 2%, they're going to fight pretty hard to keep that as the target for a litany of good reasons. But it also means that we're likely to see higher real rates, and we're likely to see higher nominal rates, and that will have a real implication on the cost of funding our enormous deficit. The U.S. has $33 trillion of debt outstanding. We didn't plan for an era with higher nominal and higher real rates when we went on the spending spree that created a $33 trillion deficit.
I would say inflation is still, to me, the single biggest risk, certainly to economic growth, to purchasing power, to the deployment of capital. And then if you think about how perverse inflation is for those who are less well off, that has a very negative effect on prosperity, lifting people up out of poverty, or even those in the lower middle class that are trying to rise beyond the lower middle class. It's just very perverse for that category, which is in essence what all of us are trying to do in terms of driving economic growth to lift more people into the system. So I think inflation is far and away the biggest concern. And I think the geopolitics that are now overlaid in a much more profound way, in many ways you could say that the peace dividend we've had for the better part of 25 or 30 years is kind of over. And we're entering, unfortunately, perhaps a new era with more geopolitical tension, more war, more challenge that I think is going to make it even more complicated to create more economic growth.
Jenny, inflation and that journey to 2% for the Fed, I mean, the markets were quick to conclude that the Fed was done and then change its mind. Was the Fed right in standing pat?
I do think the Fed was right to stand pat. I think that, though, the journey to 2% is going to be a lot more challenging. And I would just add on, so like John, really leave a couple of things for the rest of us to talk about on the rest, okay?
He says he's paid to worry about everything.
But so completely agree with all the points that John made. I would just say the other challenge that I don't think gets enough, and you're starting to hear about it more, is, even if the Fed is able to slow the economy such that it gets inflation lower, there is this issue of just supply and demand for
U.S. Treasuries and U.S. debt. I mean, the reality is the U.S. has gone from 7 trillion or 9 trillion in 2007, 31 trillion. We're going to add 2 trillion more. You have to have buyers. Now, there'll be buyers. The question is, at what price will there be buyers? And then, one, how much does that crowd out other investment opportunities? And two, does that mean higher for longer, which I tend to feel like that is an issue. So I think along with the inflation, even if the Fed does their job in trying to slow it down, they don't control U.S. spending, and that debt, I think, is adding a challenge.
You asked risk. The other side of risk is return. So perhaps, if you sort of wear more of that cap, Jenny talked about, treasury bond or cash yielding more. That's a positive thing for investors. In fact, I would say, look at U.S. tips, right? U.S. 10-year tips is yielding a real yield of 2.5%. We haven't seen that for a long time. It was negative. That means you actually get inflation-protected return guaranteed, right? Because I believe the U.S. government is rock solid. For 10 years, you clip, 2.5% above inflation. That's very attractive, I would say, and that's actually great competition for a lot of other asset classes, right? If you were to take additional risk, you have to expect a return higher than that level of 2.5 real. So that's one way to look at it. Generally, asset use going higher should be good for long-term return.
A risky environment and certain environment is a great environment for healthcare. So you should be thriving.
I think that we're at a moment where we're kind of being increasingly suffering from a series of pandemics. I come from a world where we worked on a pandemic at Moderna, and we think that a pandemic means a disease that afflicts the planet. But actually, literally, a pandemic means anything that afflicts all people on the world, essentially in a negative way. And so think about what's happened. You have a pandemic, a health pandemic, that led to a financial pandemic, a supply chain pandemic, a geopolitical pandemic, a war pandemic, a misinformation pandemic, and then you have the climate pandemic waiting to get its chance to really have a big impact. And so what has that done to our general notion of economic equilibrium? Well, it's made it laughable, I think. And in nature, these things happen. It's called punctuated equilibrium. And I think we should really start thinking about, I heard a little bit this morning, when will it go back? Now, the people who wanted things to go back are the incumbents. Insurgents wanted to go forward because in the back, they really don't have a role to play because they're dominated. And so I think what you're going to see in this environment is the appearance of a different and new equilibrium state. It's very scary because obviously investors value predictable, profitable growth. There is no predictable, there's hardly any profitable, and there's hardly any growth.
I personally think that I'm more in the camp of high for longer than higher for longer. But I don't see how we can bring back inflation at target. Everybody focuses very much on the big drop, but the truth of the matter is that inflation is well above target rates across the globe, and is much stickier than we think. So I don't see how you can bring back inflation without creating an economic downturn. We start to see it now, clearly in Europe, and most possibly also in the U.S. soon.
So if you have interest rates high for longer, and there's an economic downturn, what breaks? Is it companies defaulting? Is it commercial real estate? Or are there other pockets in the market that you worry about?
Look, I would say that companies, the vast majority of the companies are well placed in terms of capital position. I'm not so concerned at this stage about the private sector. There are, and if you want to look at major events, right, black swan events or things that can really go wrong, history tells us that they usually come from government or real estate. So I think that while we look at the private sector, I think that the reality is that the most fragile part of the equation, if I look at the real estate, commercial real estate markets across the world, the post-COVID positive momentum was very short. So, and now the reality is that we see that COVID has changed the way people work. People use offices, and we see it as we speak that that one has to be watched carefully.
Coming up, John Kerry, the U.S. Special Presidential Envoy for Climate. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back to Singapore and Bloomberg New Economy Forum, Embracing Instability. I'm Eric Schatzker. Former U.S. Secretary of State John Kerry delivered a riveting close to this year's forum, setting priorities and expectations for the important work that needs to be done at COP28 in Dubai.
You ask, what is it that's in the way? The imperative of status quo, the way money works, the numbers of people who have pressured some of the oil and gas companies because they weren't doing as well as the ones that weren't doing stuff on the climate. Look at the pressure, a bunch of asset owners and managers in New York and elsewhere in the world have been under to make more money. So put it down to greed, G-R-E-E-D, greed. People do not want to transition. People are waiting. People say, oh, it's in the future. It's not in the future.
It's the biggest existential crisis facing us now.
And
but
it
getting
is being
that message,
delayed by personal and by unwillingness of people to grab the bull by the horns and do what you need to do here.
In that context, then, what's a successful COP28 in your mind?
Well, I think doing the things that are mandatory, obviously. We have a mandatory report on adaptation. I think we will increase the level of funding for adaptation, but we will balance it with mitigation. We will have major step-ups, I think, in mitigation effort, and they will come, some of them, from these sidebar things, like the shipping challenge and the agriculture mission and the First Movers Coalition and so forth. But those aren't substitutes for the fundamental need to have NDCs of countries that actually drive their country's policy to keeping 1.5 degrees alive.
The science is so clear. We're 1,200 islands in the middle of the Indian Ocean. Most of our islands are just about 1 meter above sea level, and we are observing sea level rise of 3 to 4 millimeters per year. We are seeing most of our islands are eroding at an alarming rate. Most of our islands are getting flooded during the rainy season more than we used to see. And the biggest impact that I have seen, even in my own life, is the slow death of our coral reefs, which is the source of income for us, which is the source of protection for us as well. So impacts of climate change is an everyday reality for us.
My view is for this climate transition to happen, the big thing we need is solutions at an affordable price. The US is playing a big role, I think, at the moment. Out of the money being invested, a lot of it is going to electric vehicles. So they're giving us $7,500 credit per vehicle, and the estimate is that passenger vehicles are going to go up by 13 times by 2030. This is IEA versus 3 times without the IRA. That's helping. A big one is on hydrogen. We really need a form of firming for renewable energy, and the estimate is there'll be 5.5 million tons of green hydrogen by 2030, but we need to get that price down to, say, $2 a kilogram, and the incentives in the US will probably crack the code for the world. And as Mark says, those technologies can get rolled out.
Who is going to accelerate, pull through a combination of industrial policy, our topic, but corporate action, corporate leaders, and there's a series of initiatives around that, but they're not yet getting the traction they need at scale. And then, you know, GFANs, the members, whether it's Macquarie, Brookfield, HSBC, whoever, you know, provides the financing against that really accelerates. And that's what we need to do, and that's part of the opportunity of getting everyone around the table at COP. And I think that's, so we should look for something and push for something on that front.
But you're hopeful about COP, that we get something concrete?
I think all the right people are there, and the right issues have been put on the table. So yes, I mean, in that regard, we should, you never take things for granted, but we should force the issue.
That's all from Bloomberg New Economy Forum, Embracing Instability. You can find the complete interviews and more content from the forum at Bloomberg.com and on the Bloomberg Terminal. I'm Eric Schatzker. This is Bloomberg.
Was going to keep Great World Cup. This is a three as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
There's all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure, to a time we'll be fully transparent on viewing data.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Hello and welcome to Bloomberg Screen Time. I'm Caroline Hyde.
And I'm Ed Ludlow. We're living through one of the most disruptive transformations in entertainment and pop culture, with storied Hollywood studios going head-to-head with technology giants like Netflix, Amazon, and Apple, and actors and writers striking for a bigger piece of the streaming pie and to protect against artificial intelligence.
Bloomberg Screen Time brought together media moguls, celebrities, and entrepreneurs who are influencing the next phase of pop culture. Now, while streaming and social media apps like, well, TikTok, they've upended how Hollywood does business. Some things, they remain the same. So let's start with Ari Emanuel, Endeavor and TKO CEO. He spoke with Bloomberg's Lucas Shaw on his deal to merge UFC and WWE and the future of sports.
Now, on the sports rights front, a lot of this is predicated on that market continuing to increase.
Yeah.
That has been ballooning for a long, long time.
Right.
Given what you're seeing with the kind of continued collapse of TV, the way that some...
Okay, I'm not going to interrupt you, okay?
Yeah,
the NFL
well, you know where I'm
made a
going.
10-year deal with linear television. 10 years, okay? The linear business is not going anywhere. They've also made deals on digital. We did the same thing, ESPN, ESPN Plus on the UFC side. WWE did, Peacock, Showtime, USA Network, and Fox, which is whatever. So the linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down, right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
You mentioned Oppenheimer. We can talk about Barbie, although that's not one of your movies. Your two big movies of the year were Mario and Oppenheimer. Which of those was a bigger surprise to you?
I think probably Oppenheimer, an R-rated film with that subject matter and, at the running time. And I wasn't surprised that it was successful, right? I mean, it's Christopher Nolan. We know that he is a singular filmmaker who audiences globally really want to go see. But I was really surprised at the sort of the breadth of the audience, the demographic. It skewed from young kids, not young kids, but teenagers, all the way up to an older audience. So it was pretty surprising.
Do you feel like the success of Oppenheimer says anything about the business, or is it the case that Chris Nolan and Quentin Tarantino seem like two filmmakers where if they make a movie, they're like a brand, right? Even if they're original, people will show up to see them.
I think in the case of Christopher Nolan, he makes films for the big screen, and really for the big screen only. Of course, you can watch a Christopher Nolan movie at home, and eventually you'll be able to do that. But, you know, I mean, everything he does from shooting on IMAX to, you know, to 70 millimeter, to the way that, you know, he really his films encourage audiences to experience his films on IMAX screens and in the large format. I think it all speaks to, again, I use that word, a sort of singular cinematic experience. You know what you're going to get, not subject matter wise, but you know you're going to get a very fulfilling experience at the movie theater, and sort of, quite frankly, value for your money.
If you were Bob Iger, what would you do with ESPN?
I would sell it.
To who?
I would sell it to Apple, and Apple could take their entire budget for 2 episodes of the morning show and pay for ESPN, and I think that makes a lot of sense. They could be like, you know what, maybe we don't need to launch a rocket in outer space in episode 1. We'll just buy ESPN instead. And that'll be it.
Related question, regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves and own League Pass themselves and do it in a way that they could just basically own all of it. And I don't know if they'll do that or they'll have the to do it, but they, you know, with the media rights deal that they're going to get from the national games, they're going to make so much money and the players are going to be paid so much money. Like, we're going to have guys making 75, 80 million a year. So if there was ever a time for them to kind of bet on themselves, that's the league to do it.
There's all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, you know, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, you know, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
Does that mean it's, sorry, go ahead.
No, so that will demystify this for a lot of people, which is basically what I can care about the most is relative to what it costs to put on the air, are people watching? And when they push play, do they stay? So if they push play and then drop out in the second or third season, or third
which is completion rate for...
Yeah, so those things all matter, but they all add up to the same thing, which is engagement. So I think you can, all the data is really there. You might have to triangulate it a little bit to get to it, but all the data is really there.
What was the toughest cancellation decision you've had recently?
They're all tough. You know, the reason why, because I think that people have got a real fandom. They really love these. Some people really love all these shows, even if the rest of the world doesn't agree with them. So for them, that's why you see sometimes these very obscure shows, and you hear very loud campaigns about stop the cancellations, because they have such an intense relationship with it. That's why I love this business so much. I relate to it. Sometimes my personal taste is really far outside of the norm, and what I've been decent at over the years, and pick people who are good at doing this. But when I look at it, I think it's if it was programming to my taste, we'd be very small. So we're trying to program to the world's taste. But they're all hard. They really are all difficult decisions to make because people love these shows so much, and there's some things are just a puzzle. You scratch your head, but relative to what it costs to put on the air, did we pick a good show? Did we execute on it well? And did we pay the right price to make it?
Coming up, Padma Lakshmi on elevating food across screens. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Welcome back to Bloomberg Screen Time. I'm Caroline Hyde. You know Padma Lakshmi from her 2 decades hosting Top Chef. I spoke with her about her new show, Taste the Nation, and how she created a show highlighting the immigrant and indigenous experiences creating American food.
Yes, Taste the Nation is really a political show. You know, it's just disguising.
Did you mean it to be?
Yes, it's very, yes. I mean, I meant for you to see and not see everything you saw and not saw in Taste the Nation. I mean, as much as I am in front of the camera on that show, most of the work that I do on that show is behind the camera, with our stories, with our episode producers, with our research, writing the, voiceover, all of it. And I think that's been a real gift, to be able to hone muscles I didn't know I had, didn't know I wanted. And it's very gratifying. It's always really a privilege, and you just feel so lucky to be able to have an interest and a keen passion about something, and then actually be able to do it at work, at the level that you want to do. And I think that, to me, has been the greatest gift that Top Chef has given me, because I would never have Taste the Nation if I hadn't helped build Top Chef. And while Taste the Nation may be more aligned with my own interests or, my own vision or taste level, Top Chef is also something that I'm really proud of, as far as, what we've done in television and what we've done in food, and also what we've done just to affect how a generation of young people around the world, not just in America, think about their food.
How do you go and sell those stories? Whose ear do you need to gravitate towards or call towards you to say it needs to go on Hulu and it needs to go on in this particular manner, and how?
How do I sell it? Well, I mean, I do a lot of things like this, but I mean, not that much, but I think good programming finds its way. I mean, I sell it through building my social media platform. Like, I enjoy social media, but I don't have something to say every day, but I have to post every day. And so I'm learning how to do that.
Does that frustrate you?
it's time consuming.
Yeah.
Listen, for me, social media has been a very, very effective tool, not only to tell you about books that I've written or shows that I'm passionate about, but also to do my advocacy work.
Yes.
Whether it's with the United Nations or ACLU or Planned Parenthood or whatever. So for me, it was a megaphone that allowed me to talk about women's reproductive health. It was a megaphone that let me find my audience. I think it's really good for that because it's a way for you to communicate directly with the people who you think are your potential audience.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
But as we've grown over the last couple of decades, I think that we really do want to do things that we completely enjoy and that makes sense and that we're passionate about, you know, because it's very difficult to do something that you're really not that into. So I think my job is to identify a company or a product or a business and then helping to build the team that's around that. Yeah. It's like with Skims, for example, I can use that. Kim thought about doing a shapewear company for 10 years. And Kim and I were in Cannes, and she was with Kendall, and they were going to do the red carpet. And I went up to get Kim, and she was leaning over a bathtub filled with warm water and tea bags, and she was dyeing her underwear and cutting it up. And I said, "What are you doing? You've got to be downstairs in 10 minutes." You know, she goes, "I got it," and they're blow drying the stuff. She goes, "This is just really what I want to do." And she did that for years. And then, you know, suddenly it was time to start this business. And so I asked the partners that we have now in Skims to come on board. Would they like to help us manufacture? Because I knew how to make makeup and beauty. I wasn't sure exactly how to make shapewear, you know, so I knew I had to find somebody who was great at manufacturing clothing and running that kind of a company. So I think that's a good example of how we are, you know, our ecosystem and our process works. You know, we identify a business, we, you know, get it funded and try to get it off the ground, and then we find the best team of people to put around that company.
The sale of ABC stations.
Yeah,
was about
ABC stations and network.
Correct.
Yeah.
And have you already submitted a bid, or you're looking to submit a bid?
Well, I submitted a bid. I texted it to Bob.
Okay. Okay.
Bob was on I'm sorry, he was on some other network, and Bob said he didn't see you know, linear networks as being core.
Yeah.
I said, got my mobile phone and said, "Here you go." And it was very straightforward. It's like, hey, whatever your EBITDA is, because, you know, I'm willing to pay you an 8X. So just open the books, let's go. But they're not ready to sell. He's not ready to sell. But I wanted to make it clear.
Why do you say he's not ready to sell?
Well, they've made that statement. They're not there. That's a complicated thing. They have to bifurcate that. They have to pull that out of the Disney system. That's a tough thing to do. And Bob is brilliant. He's excellent at what he does. When he's ready to sell, I just told him, you don't need to make more than one phone call. I'm your man. Call me. Everybody else is a waste of time. Call me. I'll get it done. What you want?
And also,
so, listen, the money is easy. The money is very easy. There's plenty of money. There's $80 trillion out there floating around looking for, great management. That's the real commodity. Great management. That's the commodity, right? There's $80 trillion out there. You don't have 80 trillion Byron Allens. Okay, you want your money back with a return? Call me. All right,
Also, too,
so I said to Bob, right, just to be really clear,
go ahead.
I'm ready when you are, but it's not about the money. It's about certainty of close. And very few people can get a deal like that. ABC News, get that approved in Washington, D.C. And what you don't want to do is go sell it to somebody that can't get the deal closed, and now you're walking around in adult diapers for a year.
Coming up, how gaming is changing the face of entertainment. This is Bloomberg.
Welcome back to Bloomberg Screen Time. I'm Ed Ludlow. Video game adaptations have been having a moment, from the Super Mario Brothers movie to HBO's The Last of Us. I spoke with Helen Chiang, Minecraft franchise head, and Brian Wright, Riot Games Chief Content Officer, on how video game IP is going to make the next leap from the gaming screen to the silver screen.
Yeah, I think gaming and entertainment go hand in hand. When Minecraft started, it was a small independent game. It's evolved into a multi-billion-dollar franchise. We're really excited to expand into entertainment because we think of it as a great opportunity to reach new audiences and bring them into the franchise, even if they're not going to play the game.
There is a Minecraft movie. Well, there is a Minecraft movie.
There is.
Please expand.
It's under production right now. We're really excited to be working with Warner Brothers. We have the movie that's upcoming. We're working with Jason Momoa. It's a little bit delayed right now because of all of everything that's going on.
That's largely because of the pandemic.
Definitely.
Please continue.
But we're really excited because I think it's going to be just another expression of Minecraft that brings in a whole new audience into the franchise. We're hoping it's the start of many different entertainment offerings that we'll have with Minecraft.
Is the idea that whatever the end result that the movie looks like, that it's recognizable to kind of the generations of players that were playing Minecraft across different mediums?
Absolutely. I think one of the challenges that we've had is, Minecraft isn't known for the highest fidelity graphics. So as we were trying to imagine what the art style for this movie was, I just saw some creative of that this week. I think we're really excited, and I think our fans are going to
Well, Jason Momoa might not sign on if you pixelate his face. But you've been through this, well, I'm assuming, I'm not an actor, but you've been through this process with Arcane. So Helen's going through it now. You've published, essentially. What was your learning from that, taking League of Legends and doing that?
Yeah, it was interesting, and there was a lot of nerves at Riot pre-launch of Arcane because, it was highly anticipated. They'd spent 6 years making it. And there's an extremely sort of like obsession with excellence at the company. But they didn't know, obviously, how it was going to land until it's out there in the world. And the response was overwhelming. The player community just like lost their minds. And the way to answer your question, just one question ago, which is like, what do I think makes for a good adaptation? For me, it really all comes back to character. And that's what Christian and Alex, who created, they were actually rioters, internal guys. One was from the Champion team, one was on the music team, and they actually created Arcane. But they focused the spotlight on a couple of champions, which we call them champions. They're characters, Jinx and Vi, really at the center of this thing. And they're not just like running around like blowing up things for the sake of blowing up things. Like there's reasons, like deep seated personal reasons.
There's a story.
There's a story, but the story didn't necessarily, whereas ours is not a narrative game, right? Unlike Naughty Dog, like Last of Us, that's a narrative game. Like League of Legends is a 5-on-5 MOBA. It's a 45-minute fantasy basketball matchup, right? So, but we do have supporting literature and supporting website and short stories that we publish that to give you a sense more of like what these characters and champions are up to. But they had a lot of license to go create that story and create that narrative, but they stayed deeply authentic to who those champions were.
Gaming and gamers have been probably one of our oldest, and for the longest time, most important verticals on our platform, including esports, but really across the full gamut there. A lot of what is consumed there is, video on demand, which is kind of the core essence of our YouTube platform. But increasingly, a lot of that is live. And our investment there has been twofold. One is distribution, to make sure that, esports gamers or gamers in general, or live streamers even more broadly, have access to audiences that they can easily be discovered. If you are a fan and one of your favorite esports or gamers is going live, we should be able to find it. And then the second is monetization capabilities. So insertion of ads and things like that, that's been a priority for us, but also alternative monetization. So our investment in things like super chat, super stickers,
subscriptions,
channel memberships, channel gifting, has actually, a lot of it has been born out of and driven through the gaming community.
And that's all from Bloomberg Screen Time.
You can find full interviews and panel discussions at Bloomberg.com and on the Bloomberg Terminal. I'm Caroline Hyde.
I'm Ed Ludlow, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop
until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Welcome to the best of the Bloomberg Transition Finance Action Forum. I'm Francine Lacroix. This forum brought together global leaders from the private and public sectors to focus on what's been achieved in transition finance and to propel continuing action to support a global net zero economic transformation. Let's begin with the European perspective and my conversation with Ursula von der Leyen, the President of the European Commission.
COP28 is a decisive moment, and my expectations and my hope is that we're going to be successful in three fields. First, ambition. Second, targets. And the third is finance. What ambition is concerned, we need more ambition. We know that at the moment being, we are off track, but we can still make it to keep the 1.5 degrees Celsius warming limited to that point. And therefore, we need to increase our ambition. The ambition of the nationally determined contributions of the different countries at the COP28, but also, for example, to peak greenhouse gas emissions in 25. Or for example, to be very clear on getting rid of unabated fossil fuels. These are topics that are very important. The second is targets. It was Mike Bloomberg said it, only what gets measured gets done. And we do not have at the moment being a global target how we want to deploy renewable energy till 2030. And we need such a global target because really we have to be on the right trajectory. Therefore, I hope we're going to have a global target defined that we triple the deployment of renewable energy till 2030, and that we double energy efficiency. Doubling energy efficiency means energy we do not use. And the third topic is climate finance. So ambition, targets, finance.
And President, do you see that resolve from world leaders to actually come together and get more done in those three fields?
Yes, of course. I mean, it's still a time in the run-up to the COP28 where we have to negotiate intensively. But a typical topic is, for example, climate finance. As you know, there is the promise out there since years now that the highly industrialized countries deliver 100 billion dollars, sorry, 100 billion dollars every year to developing countries and emerging economies. I'm deeply convinced that this year we're going to make it and we're going to deliver. The European Union is contributing its fair share with $27 billion. So I hope that the others step up too. And this is a matter of trust. If we deliver, the developing countries trust the whole process, and then we can move forward with the ambition, for example.
And the scale of this is immense, right? How much of this money is actually needed for emerging economies? What's the one thing that could hold them back?
Well, on one hand, you need for the emerging economies public investment from us, but you also need to attract private capital. It won't work without private capital. And there we have a new initiative because we've seen one of the most effective tools to nudge private capital into green projects, sustainable projects, are green bonds. The European Union has the largest green bond market. The green bond market otherwise is dominated by the United States and China, but there are no developing countries or low and middle income countries that have sufficient green bond markets. So we've decided we're going to share our expertise with the low and middle income countries so that they can build up their green bond markets. And we're going to be an anchor investor. That's very important. Providing round about $1 billion to leverage up to 15 to 20 billion, because we have to de-risk for the private capital the investment that they are doing. So the green bond market's one of the major projects we're launching right now, and I put a lot of hope in it that it will attract the necessary capital, private capital, to the low and middle income countries.
Is there anything else that actually Europe can offer in terms of attracting this private capital to emerging economies?
Yes, there's a second big topic that we have. We call it Global Gateway.
Yeah.
Global Gateway is our investment program for critical infrastructure abroad, and of course a big chunk goes into green projects, sustainable projects. And here, together with the private capital that we're leveraging, it's around 300 billion euros that are ready to be invested. And here it's very fascinating because, I mean, if we want to master the clean transition to renewable energies, we need the Global South. The Global South has all the resources in abundance, the wind and the sun, but it doesn't have the infrastructure. So it's a perfect match. If Global Gateway is there, our task is with Global Gateway to de-risk private capital here, to create, for example, a conducive judicial environment or regulatory environment for projects that are going forward. I give you examples. We have now green hydrogen projects with Kenya and with Namibia started, but also with India, with Chile, for example. Or we have projects on forest management with Brazil, with Zambia, with Indonesia. We have a lot of projects for solar and wind. So all critical infrastructure, it's a win-win situation. We need this additional renewable energy. For example, I was just talking about the targets till 2030, a tripling of deployment of renewable energy. And here, for the private capital that really wants to go into these projects, we are de-risking, and we're the ones also who are showing this is true and trusted as a project.
President, the Global South is worried that actually the cost of capital is so much higher for them. Do you share the same concerns?
The cost of capital is higher. If, for example, if we look at wind onshore, it's 3.3% in the European Union. Yeah. It's around 7.2% in Africa. If you look at solar, it's around 4% in the European Union, 8% in Africa. So this is where Global Gateway is absolutely the right instrument to go in there, de-risk, be the anchor investor, make sure that the project functions, and attract private capital to these projects.
President, going back to some of the green bond markets that some of these economies can develop themselves, what's the hardest thing about that, apart from attracting capital? Is there any advice that you would give?
Well, yes, it is. I mean, you start from scratch. It's lots of technicalities. It's very technical. So to share this expertise, we built up our green bond market, so to share everything what is necessary for it. Of course, to invest also at the beginning that this green bond market can be build up, and then get supply and demand at the same time started. This is why we are so important as anchor investor.
Where do you see it first? So how much and how quickly can that scale up, you think?
Depends on the speed that we are developing, but we've seen in our own green bond market, it was a steep rise immediately of the demand is out there. There's a lot of capital out there that is looking for the good projects. So we've seen it with the own green bond market. It really went like this, oversubscribed enormously. Therefore, the idea was born to do the same for the low and middle income countries. And as I said, the resources they have them in abundance. They need the infrastructure, and therefore there's a lot of good capital out there that is looking for the reliable projects. Therefore, it's a perfect match.
Coming up, U.S. Treasury Secretary Janet Yellen. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Welcome back to the Bloomberg Transition Finance Action Forum. I'm Francine Lacroix. Since becoming Treasury Secretary, Janet Yellen has warned of the dangers that climate change could have on the global economy. Speaking at the forum, she was no less forceful. Take a look.
The physical impacts of climate change are impossible to ignore. We've seen record-breaking heat waves that have led to a tragic spike in heat-related deaths and hospitalizations. Unprecedented storms and wildfires are destroying homes and undermining livelihoods. Vulnerable populations globally are disproportionately affected because of where they live and the industries in which they work, and low-income Americans are no exception. Such events impose significant economic costs. Global economic losses from natural disasters amounted to almost $200 billion during the first half of this year. Households face increasing challenges, and firms have assets and business models that may be at risk in a world with substantial climate change. It's no surprise then that the climate crisis is propelling a massive economic shift. There's increasing demand for technologies, products, and services that will reduce greenhouse gas emissions and support a clean energy future. In the United States, government support is playing a role in accelerating this transition. President Biden's bipartisan infrastructure law provides funding for wide-ranging investments, including $7.5 billion in electric vehicle charging, $10 billion in clean transportation, and over $20 billion to upgrade the power grid. The Inflation Reduction Act, the most ambitious climate law in U.S. history, expands demand and supply-side incentives for clean energy investment and production. At the Treasury Department, our economists, lawyers, and other experts are working tirelessly to support implementation, including through issuing rules on wide-ranging tax incentives. And private sector companies are responding, and quickly. Over the past 2.5 years, they've committed $240 billion in new clean energy manufacturing investments. The Treasury Department has surveyed how financial institutions are setting and meeting net zero commitments. We've engaged in discussions with market participants, research organizations, and civil society organizations. We've tracked the substantial body of research, guidelines, and voluntary standards on net zero financing, investment, and advisory services. And through this work, we've identified the need for greater clarity on best practices around these commitments. So we are proud to launch the Net Zero Principles in response. Our goal is to affirm the importance of credible net zero commitments and to encourage financial institutions that make them to take consistent approaches to implementation. Our work will also help institutions that have not yet made commitments see what doing so might entail. The principles draw on the emerging best practices that we're seeing in the financial sector. They establish that financial institutions' net zero commitments should be in line with limiting the increase in the global average temperature to 1.5 degrees Celsius. They affirm that financial institutions that have made these commitments should develop transition plans with clear practices, targets, and metrics, and that they should support their clients and portfolio companies in adopting their own transition plans. The principles also outline specific activities that are particularly important to effective net zero commitments. These include providing transition finance, such as for clients pursuing decarbonization in high-emitting sectors, and focusing on climate solutions, such as making investments in cutting-edge clean energy technologies.
We have in London now the world's biggest clean air zone, covering an area more than 600 square miles. 9 million Londoners are now breathing clean air. But if you look at the history of these policies, there's always been initial pushback. The initial congestion charge in London, 2003, opposition. No one would dream of reversing that congestion charge. In 2008, we brought in a low emission zone for big vehicles. All of London was covered. A lot of objection from those who were drivers of lorries. Would dream of reversing that. When I brought in the first ever ultra low emission zone in central London, lots of concern. But we saw in a couple of years a reduction of almost 50% of toxic air, a third fewer children being admitted to hospital because of air pollution illnesses. We expanded it, some opposition there, but we saw a 20% reduction in air pollution. There has been some genuine concerns that Londoners have had, which we've sought to address. 3 weeks in now, since the US was expanded, and people have realized actually their vehicle probably is compliant. They're not paying a penny more. They're seeing the benefits of cleaner air.
We're also hearing reports that the government is trying to possibly water down some of the previous commitments made to net zero. Is climate change now toxic?
Well, what's happening is some people are trying to weaponize climate change, weaponize air pollution. And here's the perversity of what Prime Minister Sunak is doing. We've seen in the UK in September, in London in September, for the first time ever, 4 consecutive days of temperatures north of 30 degrees Celsius. We saw last year in London temperatures north of 40 degrees Celsius, wildfires in London. We've seen across Europe and the global north in America, wildfires, droughts, heat waves. The response of government should be actually to turn this awful crisis into an opportunity, creating green jobs, a Green New Deal, thinking about how we can both save the planet, address climate change, but also give people security and have that just transition. And this is basically, lazy politics from a weak prime minister throwing red meat to his backbenchers because he's so weak and ineffectual.
Mayor, what are you most excited about in the climate space? So is it green bond issuance? Can London financial as a center actually become a hub for green finance and green issuance?
We started our conversation by you talking about the ultra emission zone, the world's biggest clean air zone. There are so many exciting things happening in London. We have the largest amount of electric buses in the Western world, the largest amount of rapid charging points in Western Europe, I beg your pardon. Record numbers of trees being planted, rewilding, half our taxis are electric. What I'm saying to investors around the globe is London is the green capital of the world. This crisis of the climate emergency can be an opportunity. We have a green bond in London, more than £500 million come to London invest, and also at the same time make sure that the London Stock Exchange is known as the Green Stock Exchange.
Coming up, more from the Bloomberg Transition Finance Action Forum. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Plaza Hotel and the Bloomberg Transition Finance Action Forum. I'm Francine Lacqua. Transition to a net zero future will require private capital as well. Here's the former BOE governor, Mark Carney, with leaders from HSBC, MSCI, and Prudential, talking about the work private finance is doing to support the net zero economic transition.
The $100 trillion economy relies on measurements. If we say, what's the unemployment rate in this country, that country, what's the economic growth, how much trade between this and all of that, you need data and you need measurements and you need standards. So the climate transition is going to be an overlay on all of that. Yeah. So what doesn't get measured doesn't get done. We know that. So what we're focusing in those two components. The first component is how do we go around measuring carbon emissions, future carbon emissions, valuation of assets, financial assets, risk of those assets, et cetera. So a lot of our work is in doing all of that. Now, for that, you need data and you need models. So we are, we're extremely focused on that. And at the moment, to give you a report of where we are, we have climate emission estimates on about 4 million financial instruments, which compose of about 1.1 million assets, meaning manufacturing plants, office buildings, mines, et cetera, storage facilities, et cetera. And when you distill it down to, it's about 68,000 companies and issuers, and about 70,000 funds, ETF funds, mutual funds, and private equity funds, private debt funds, et cetera. So we are focusing on the collection of the data, but that's a small part. You got to then model the data to be able to understand what are the current emissions and the future emissions. So, for example, if you take all the listed companies in the world today, they emit somewhere about 12.5 billion metric tons. 20 years from now, our estimate is going to be 17.5 billion. We're not going in the right direction, 17.5 billion. So that's the first part. So our ambition is to be able to flood the world with so much data and measurements that they don't have to worry about the data and the measurements. That what they will worry about are the action plans associated with dealing with the transition.
So Noel, how are we attacking this problem? Where are we? What are the real priorities to get capital to the emerging developing world for climate?
Well, listen, certainly I can talk for Asia very deeply, but most importantly, I say I'm very encouraged when I talk to clients and customers in Asia. Take India, for example, some of the largest corporates in India. The amount of money they are investing in building new infrastructure, using their own private sector capacity, requiring not a huge amount from the governments to make that investment become a reality, very often just planning consent. I'm encouraged that there's a huge amount of action already taking place on changing to green energy, on electrification. So there's a lot happening. However, there are some projects that require private and public sector to work together. The early retirement of coal cannot be achieved by the private sector alone. It requires public policy. It requires public financial support in certain countries. So those are challenging parts of the transition to a green energy. And I think we have to find a way to scale that fast And I worry at the moment that too many of those conversations are happening project by project. There isn't an architecture.
So Noel is completely right that in the absence of a carbon price, it's very hard for us to spontaneously, as a private sector, create the levels of finance that we're talking about. After all, we're financing quite often, global public goods and externality. Yeah. So we need to have the partnership with multilateral development banks as mobilizers in chief of private finance. But currently, they only mobilize about, say, 1.2 times, roughly, or even less, but in some cases, of the amount of money that they put into emerging markets, and we need to have multiples of that. And so Noel is completely right. The way to do that is to have models and financing structures that are speedy, with no disrespect to my dear friends at the various multilateral banks. I mean, you cannot be there for 3 years structuring something. It is just, we don't have the patience for it in the private sector. So we need to have something that is speedy, at scale, replicable, not bespoke, standardizable, creates liquidity in the market. And so what we're working on, what we've been thinking through, and we're going to have our first meeting this week, is what are the sorts of things that you just put out there. They're simplified and at scale, and they're speedy. So it could be around guarantees. We had a discussion that you chaired this afternoon, Mark, on foreign exchange, which is a big deterrent for foreign investors. We could talk about securitizations, and we could talk about creating liquidity. So those are the sorts of things we're talking about.
And that's all from the Bloomberg Transition Finance Action Forum. You can find complete interviews and panels at Bloomberg.com and on the Bloomberg Terminal. I'm Francine Lacqua, and this is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
There's all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going through things like the top 10 and through things like we published the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
If I can have everybody answer the same question, what do you come to work to do every day? And the answer to that is because we're the custodians and we're responsible for the savings and the pensions of real people like my mum and dad and your mum and dad, then we do a better job every day.
It's the world's largest listed hedge fund manager. And after 240 years in existence, Man Group has a woman in charge for the very first time. Robin Grew was promoted from president to chief executive last September, the high point of a 15-year career at the firm. The former barrister entered the world of finance 3 decades ago and never left.
The speed of change, the impact, the global nature, the challenge of it just never stopped getting more and more infectious for me.
In this episode of Leaders with Lacqua, I speak to Robin Grew about diversity, purpose, and what the future holds in an ever-changing world. Robin Grew, thank you so much for joining us on Leaders. The world is a bit strange. There are so many polycrises, or whatever you want to call it. It's just difficult to get a handle of what comes next.
Yes, that would be the shortest answer I could ever give. Yes, it is difficult. I think that if this year has taught us anything, it's that prediction is not our strongest suit, perhaps. And that isn't just in relation to markets, it's in relation to these big geopolitical events that we are still living with.
But it's quite incredible to think that we're in a better place than we thought. I feel like every 6 months, there's like the doom and gloom crew saying, this is it, interest rates have gone too much, we need to reevaluate what happens next. And yet, the economy holds.
I think that's right. I think when we talk about it and we have this conversation about higher for longer, which I still say out loud, and then cross my fingers in some ways that maybe I'm going to be entirely wrong, but higher for longer. I think where the nuance is in that message is that what we're unlikely to see is 0%. We're probably unlikely to see 2%. We may see some 50 basis points adjustments, for sure. But I think what we have been signalled clearly from central banks is that they're not frightened of using policy to control inflation or to try and respond to inflation. And I think that's the messaging we should all kind of get used to. Last 10 years, 0% free money. Next 10 years, higher for longer, with that slight nuance in the way that I described.
And I imagine that 2024 could be difficult because of volatility and
dispersion.
And yeah,
yes.
So it makes it harder actually to manage money.
I think it does. And I think the denomination effect that we saw because of the kind of the hiccups in the system with the banking crisis and with LDI, that also put a premium back into liquidity. So what's your duration risk? What's your liquidity risk? How do you manage through these different economic cycles? And are you prepared or are you ready for hedging, which means that, let's remember what that means. It means that at times you're going to do well and at times you're not going to do well with the entirety of your portfolio. And that's okay, that actually managing your portfolio for these different changing economic cycles or behaviors is what you're supposed to be doing.
Does it change how you lead Man Group?
It changes because of the way that we position the organization. We are an organization that is diverse. Our capabilities are diverse. We have different engines doing different things, be it in the quant side or on that fundamental discretionary side. We have products that are in the macro space, products that are in equities. We are long only, we are long short. But what we are seeing is our clients are interested in more customized solutions, in solutions that actually answer the problem they've got or the challenge they have, rather than here's a product, you buy that or nothing else. So it changes in the way that you deliver an organization. It changes in the fact that the value you're driving towards is not just about here's a product, but it's here's a solution.
So what does it mean in how you're focusing your energy on in 2024? I know you want to be in the private credit space.
Yep.
But I guess hiring is also something that you need to think of carefully.
We don't make widgets. What we have are highly talented individuals who are focused on being the very best they can be in the workplace and delivering what they do. And that can be alpha in our engines, or it can be in our operations and middle office department, or it can be in our legal department. It's about a war on talent. So hiring the very best people, retaining, keeping those people, giving them opportunity, giving them a space where they can be the very best they can be is incredibly important. So it's tech, it's talent, it's vision. It's about knowing that when people come to work every day, every single person at Man Group adds value and is valued. That's important. It's that moment. If I can have everybody answer the same question, you know, what do you come to work to do every day? And the answer to that is because we're the custodians and we're responsible for the savings and the pensions of real people like my mum and dad and your mum and dad, then we do a better job every day.
But so how do you hire? Again, you know, there's a war on talent, or there's a battle to get the very best.
Yeah.
So what do they want?
They want, so depends. I think that's the one size doesn't fit all thing. Who doesn't want to be around really smart people? Number one. Who doesn't want to be around a place which values your input? Who doesn't want to be in a place that doesn't seek to be better today than it was yesterday and better tomorrow than it is today? Who doesn't want to be around a place which is actually interested in you as a person and interested in being capable of making you better? So where do we go? We go broad, we go wide, we look for difference, we look for energy and excitement, that person who's able to get energized.
You don't always hear that from a big finance chief executive.
Okay, I'm not
Is there a
apologizing.
perception problem for finance?
I think finance hasn't done as good a job as we might in explaining the value we bring to society more generally. I don't cure cancer. That's not what I do. I wish I could. I mean, I wish I was that smart and capable to do that. But what we do is protect and enrich the savings and the pensions of people who've worked incredibly hard all of their lives and diligently put their money aside in their 401k or wherever it may be. And we're entrusted with that, and we can give them, if we do our job well, financial security. We can provide something that enables legacy investing. It enables access to healthcare, to education, to a roof over your head, to pay the bills, to all of those things. That's a pretty important thing to do.
I mean, it's amazing. You seem to be filled with a big sense of purpose, which you don't often get from hedge fund managers.
I have a big sense of purpose. I run a firm that has a big sense of purpose, and I think that energy is something we should put to work. When I sit down with big allocators and we talk about what it is we're both trying to do, it's the same. I think the day we forget that, and the day that I think about our numbers in the sort of the institutional size numbers that we all talk about, we lose a bit of that sense of what we're here to do properly.
Coming up, Robin Brew on adapting to change in an uncertain future.
I'm not good at predicting what the next year or the next 5 years is going to be. What we need to do is be flexible, is to understand and be dynamic, to think about the impact of markets and changes.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From renewed geopolitical risks to climate change, a new era for interest rates, and a different working reality, the world of finance is also adapting to change. I continue the conversation with Man Group Chief Executive, Robin Grew. Do you worry about what the future economic, footprint looks like for the world?
So our job is to say, how do we think about what could happen? How do you stress your portfolio? How do you think about what your outcomes are today? People drawing their pensions today versus drawing their pensions 50 years from now. Man Group is 240 years old. We match the duration rather neatly of some of our clients who aren't thinking about just returns for a year from now, but are trying to think about what they're planning for 30 years from now. We're not good at predicting. I'm not good at predicting what the next year or the next 5 years is going to be. What we need to do is be flexible, is to understand and be dynamic, to think about the impact of markets and changes.
Are you more worried about geopolitics or about market functioning?
Well, I think the fact that we've now changed geopolitics to geoeconomics is something of an impact point. So as we think about what happened when Russia invaded Ukraine and the impact on our fossil fuel pricing, or you think about the worries and concerns around supply chains post-COVID and the fact of these buffers, when you think about corporate real estate and the refinancing that is inevitable. I mean, it's not a 30-year mortgage. These are things coming up for refinance within the next, 3, 4, 5 years. That's a lot of money being put to work. And we're in an environment where we look out onto the city, office buildings are in a different place and have a different level of occupancy than we've seen before. So these are big changes. And geoeconomics, I think, and things that we have to take into consideration.
What do you worry about the most? Do you have like a ranking, or is it almost one and the same? It's just this huge transformation and change.
I think it is a transformation and change. I think that we're going to see credit markets playing a role. I don't think that's a short-term thing. I think that's a real-term thing. I think if you see lending tightening, you're going to see still a need for financing out there. But it isn't that all things are created equal. I'm a big proponent of active management. I am a big proponent of credit. But not every active manager or not every credit expert is going to be able to deliver in these environments. There is expertise and skill needed. How do I think about prioritization? I think about priorities in terms of capabilities. I think about being as skilled as we can be in data, in analytics, in tech, in credit, in multiple asset classes, and then being able to pivot those. I think that's where I think about things. But do I think about that's the number one thing I'm focusing on? I don't have the luxury of that. I think we have to think about all of these things.
I mean, are you looking at acquisitions to be in certain spaces?
We have always said that we will grow the firm organically, and we will always look for acquisitions to increase our capability on content for clients. I think what's interesting, as we completed our acquisition with a private credit manager in the US in the middle market, I think what's interesting is that the multiples look more interesting. I think we've been talking about consolidation, right? We have been talking about consolidation since the GFC. Since the GFC. I mean, this is one of those points I'm going to perhaps want to laugh about in a few years' time from now. But I actually think as we look at the barriers to entry in this space, if we look about the cost of running our businesses, if we think about the scale that we need to operate at, I think, and the multiples that we're starting to see coming down, I think this could be an interesting time for consolidation.
But why has it been a long time coming? Is it regulation, or there was just no appetite, or it just wasn't ripe?
I think when cash is free, it softens that. I think the moment where people need to deploy at scale in liquid markets has been something that's softened. If you look at the trend has been in passive, it's been in private equity. If you think about the number of assets that no longer sit in the public domain, that's been our themes over the last 10 years. I think when private equity doesn't have quite as much cash, when that raising is harder, when lending is harder, these opportunities for niche spaces and expertise to come about, and they want scale. They need to be able to operate at scale, and having an organization that can deliver the amount of scale we've put in play, the bit that perhaps is less sexy and exciting, but that infrastructure, the ability to take businesses and grow them, that's what we do.
What do you think of the City of London? Will it lose a bit of a luster? There's a lot it can offer. Like, where do you see it in 5 years?
You're looking at a UK, well, you're talking to a UK-listed CEO, so I could not be more interested in UK PLC. I think we have held such an extraordinary position in financial markets and generally, so anything we can do to keep that shine, I think, is important. But competition is high. And we shouldn't, in the way that we shouldn't in our firms, sit on our hands and think that all of our history is going to count for long if we don't keep running. So I'm a great believer that we drive and continue to drive UK PLC. There is such a lot of innovation and creativity and growth here. There's such a lot of expertise that sits in these small shores. So anything we can do to keep that alive and keep it at its top game, I'm all for. But we operate as a global organisation, and I'm going to go where there is strong capability to invest, where the markets are deeper, where the clients need us to be, and where we can find opportunity. And I'm going to continue to look for that. But I'm a UK-listed CEO who can't help but want this to be great too.
Up next, Robin Grew on being a female leader in an industry traditionally dominated by men.
I am hopeful that we're going to see a better reflection of difference at the top of every organisation, be it financial services or broader than that.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Women make up less than a quarter of employees at the thousands of hedge funds and other alternative investment firms globally. They're even more of a minority in senior positions. So when Man Group appointed an all-female leadership team last year, it marked a massive shift for the company and a milestone for the industry. I continue the conversation with Robin Grew. Robin, 240 years old.
Yes.
Man Group is, and you're
Not
the first
me.
female. You're the first female
Yes.
chief executive of an institution at 240 years old.
Yes.
Is it, should it have been earlier? Like, are you optimistic about the future for females in finance?
I am hopeful that we're going to see a better reflection of difference at the top of every organisation, be it financial services or broader than that. Has it been a long time coming? I can't help but say, listen, it would be terrific if we could see more female CEOs before me. I hope we're going to see a lot after me. But difference is important, and I think anything that enables us to put the most talented people at the top of organisations and to lead those organisations with enthusiasm and capability is what we're after. So I'm hopeful that I'm knocking down some doors, barriers, ceilings.
I mean, the first time someone meets you, it's like the infectious energy, right, that people notice.
Yes.
Is that how you lead?
Yes. it was one of those things. I've been accused of being many things over my time, but that sort of slight Duracell bunny, ever ready to do those battery things, just keep on going. I'm a bit that. I have an enthusiasm for what we do and a passion for what we do. It is sometimes like I'm a big boom in the room, but it's something that I think is incredibly important. You don't do this job 98%. You do this job if you can. This is where my mathematicians hate me when I say anything larger than 100%, but it's 100% plus.
Were you always like that, or is
Yes.
it something that you've learned? It's just natural.
Yes, and to some extent, it's what's forged my career. That willingness and that excitement to learn and to be part of fixing things, doing things better, has been somewhat of a hallmark. I have a ridiculous enjoyment for learning and doing things. You know, I walk into any organisation or any of our offices, and in the short journey, thankfully, in London that you have from the 0 to the 5th floor, if there's somebody in the elevator with me, I'm asking 1,000 questions. You know, they can't wait to get out of the door by the end of it in some ways. But it's that interesting what's going on and what's happening. And it's an interest in people. I fundamentally am driven by being interested in the people I work with and in the people who we're here to work for.
So you started as a criminal barrister?
I did.
And then went into finance 3 decades ago?
Yeah, something like that.
What made you switch?
The thing was this. I loved being an advocate, and perhaps I think I'm still an advocate in many ways. So what happened was I was in the criminal and the civil bar, and I thought, I'll go do this commerce thing, I thought to myself, and I will go back and become a commercial barrister. And it sucked me in, and I never went back. The speed of change, the impact, the global nature, the challenge of it just never stopped getting more and more infectious for me. And so that legal training, has it been useful? Yes. Has the advocacy thing been perhaps more useful? Probably. But it's been just the best journey.
Do you have bad days? And if you do, who do you call? Do you have a mentor?
Yes, who do you call? Ghostbusters. If I have a bad day, I've always been a half-full kind of person. Yeah. Every belief I have is that you make the best out of those tough days. Of course there are tough days. Of course there are days when you're put a challenge in front of you where performance isn't great or where I feel like we could have done a better job. Those are moments where you've got to move forward. You've got to take the next step forward. And that's what I do. I think it's resilience. I think it is part and parcel of perhaps my makeup is to be resilient. Who do I turn to? I turn to friends and family, and I take a break. I take a breather, although normally not very long a breather because I just get too excited by other things. But I fill my life. I fill my life with the things that are really positive around me. I have a great family around me. I have an extraordinary wife and a son and my parents and friends, and I am enriched by that. And so that enables me to take the next step.
Do you think there's a difference being a leader in 2024 to what it was like in even 2010? You know, does leadership or chief executive jobs need to come with more of a sense of purpose and kind of morally leading?
I think that I don't know a different way of doing it than the way I do it, and that's with a sense of purpose for sure. When you speak and you are in charge of an organization, I think it is incumbent upon leaders to be enthused and to be passionate and be engaged. I think when times are tough, when things are tricky in the world, I think it's important that you know that and that you acknowledge that in your organizations. And we have had some tough times in the world, beyond markets, in the world, for people to live their lives. We run global organizations with people who come from places that are now in war zones or that are too close to borders where there are war zones, where the challenges have been very real post-COVID, or where the issues are being felt materially in politics. And not to acknowledge that, I think, feels inauthentic.
When you're in charge of a big organization, it's tough being close to your employees.
Yes.
How do you do that?
It's about communication. It's about being available and transparent.
Yeah.
It's about setting your stall out. Who are we? What are we? What are we here to do? And how are we going to do that? How do we do that the best we can? My view is you do it by creating extraordinary and exceptional teams that have a focus and that understand the humanity of that, and that's important. To do that, you need different people. To do that, you need to bridge, because different people come with different backgrounds and different flavors of their experience of life. It isn't an easy thing to do. It's just a thing we should do.
It's tough, right? Also, I guess, employing people that will say no to you.
Yes.
How much do you think of that? Of actually being surrounded by people that say, no, this is not a great idea.
I think it's critical. If I'm going to have people around me, their excellence needs to be something I hear. It's less likely, I mean, my executive team might get cross at me at saying this, but it's really not the most likely pool of people. My executive committee is less likely the pool of people from which the next brilliant idea is going to sprout and germinate. It's going to be levels and other people within the firm. We need to hear that, and it's important that I am seen as capable of listening and changing my position. There are times when I am going to be less willing to change my position, but having somebody who's going to come from any part of your organization to say, hey, I feel this way about this issue, and I don't think I'm being heard, is important.
Where's Robin Grew in 5 years?
Still Duracell bunnying. I'm the best answer to every battery life, but perhaps on a renewable chargeable basis. So where am I? I hope still leading Man Group. I hope looking back on the last 5 years and thinking how I could do it even better. I hope driving things with the same passion and enthusiasm, and I hope with the same brilliant set of people around me.
Robin Grew, thank you so much.
You're very welcome. Thanks for having me.
What are some of the measures the government are working on in terms of addressing the artisanal challenges there?
Oh, a host of them, but fundamentally hinged on two policy pillars. One is reformation, which is reforming the sector, licensing regime, getting them equipment for the extraction of the gold from the ore without the use of mercury. As you know, we are parties to the Minamata Convention, and therefore we respect the dictates of the Minamata Convention. And then the enforcement regime, deploying law enforcement to make sure that people are arrested and so on and so on. So we're making that effort. But my point is that, my fundamental point is exploiting these mineral resources in a sustainable manner are not mutually exclusive.
Yep.
I think that they can peaceably coexist. You can exploit the resources, and several countries have done so. I don't want to mention, give examples, but I know of countries which have gone about their mining sector and their mining industry in a manner which is also protected the integrity of the environment and the climate. We can do all of that. My friend Josephine mentioned that they will use solar to mine and use gas and all of that. These are all very ambitious technological interventions we can rely on. And Ghana is doing just that.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains